Hi, this is Steve from Digreshka.com. In this video, we'll be discussing the profit and loss potential of a put option for both option buyer and option seller. What's in it for you as a put option buyer? When you're a put option buyer, you long a put option, and you're hoping to participate in the downward movement of the underlying or the stock within that specific time frame that your option expires. The premium you pay upfront is the max risk. That means the price of the option you bought will be the maximum amount that you lose, and therefore no further margin is required. As the base price or the stock price decreases, the option goes in the money and the price of the put option increases. Think about it. If the stock price of a certain underlying decreases, you can actually get it or buy the stock at a lower price than your strike and sell it with a guaranteed price to the put option seller, thereby making you a profit. And through this, the price of your put option will be more expensive. Should the base price or the stock price stay neutral or increase, your option will land out of the money and the option loses value. It's important also to remember, should the price of the underlying stock change, you don't participate on a $1 to $1 basis. Theoretically, you participate in the down move of the stock with a put option. Realistically, as a general rule, no stock having liquid options market goes to zero or so far off as to halve its value in a short period of time. Of course, that happens, but as a put option buyer, I would say you would have to spend more time in ensuring that your put options or bets are correct as to the timing and the direction of your trade. Being a put seller means you are on the short side of a put option. With this, you basically have a bullish neutral outlook on the stock or on the underlying, meaning that for the time period that your issued options are valid, you expect the stock to stay more sideways or for the stock price to go up. You receive a premium for guaranteeing the buyer a sales price, a strike, should the price go down. This exposes you to losses since you will be incurring liability or the obligation to purchase the stock at a higher price, at a higher guaranteed price, should the actual stock price be lower. However, you get to keep your premium at maturity date if your options land out of the money at the expiry. Should the stock price be above the strike price upon maturity date, it just doesn't make sense for the put option buyer to obligate the put option seller, or you as a put option seller, to acquire the stock at a lower price where he could sell higher in the market, therefore rendering the put option valueless. Theoretically, you participate in the down move of the stock. Realistically, as a general rule, no stock having liquid options market goes to zero or so far off as to halve its value in a short period of time. Markets go most of the time sideways more than anywhere else. Your main goal as an option seller is to search for well-priced options to profit from when they end out of the money, or if they are in the money, that these well-priced options have high premium that act as a bigger cushion to better your break-even point.